Are we on? Are we on? Ladies and gentlemen, I am back. I was missing last Friday. And I know every episode, a couple of Fridays, one person's been missing.
One's missing.
We're playing little musical chairs here. Look, the reason for that is I think it's getting, that time of the year, it's getting extra busy. And I know everyone who listens to this goes, mate, you're always busy. I'm like, yeah, it's a good problem. So many clients to help, so many people to help, getting fantastic results. And before I go into today's topic, I really want to say something. Today, I learned something about myself. This afternoon, I realized, and this might sound really weird now thinking of it, I love money. I absolutely love it. But not the sort of definition of, so that sentence right there must have made people go, yuck. No, but I do. I really, really do. So I was just sitting there and my CBA app went ping and a couple of $1,000 came in, right? You know how people have payroll and salaries and stuff. Mm-hmm. But it wasn't a salary. It wasn't a commission check. It was actually rent from a property. And this rent doesn't have to go out. This is not, I don't have to pay the mortgage, nothing. And this is, that money right there is from a purchase or a decision, let's call it a decision made 10 years ago. So this was not from my labors of doing Friday Night Live and having beers with my mates, but was from the fact of making a good decision 10 years ago.
Yep.
The other thing I really loved after that happened is I really loved money.
Yep.
Because I do something where I work out my burn rate. And I've talked about this a little bit. Your burn rate is, and do this exercise. Ryan, I think you should do it too. Everyone should do it. And this is not, I'm not talking money from an egotistical, oh, look at me, look, no, bro. I'm a speck of dust, in the span of universe. But the burn rate is very interesting, mate. The burn rate is if you sold everything you have, every asset, right? Everything you had, right? This is not the stuff you put on Facebook Marketplace. I mean, assets, shares, liquidated it all into cash.
Yep.
Without changing your current lifestyle as you live today. How long would that cash last you? Right? So think about it. And the beautiful thing of why I said I love money is because 10 years ago, the decisions I made, whether my business changed or not, whether my personal income changed or not, my burn rate changed because as assets matured. At one point, a property that was bought for $600,000 with a $480,000 mortgage. The mortgage is still $480,000. Fuck, paying the principal. Interest only as long as I die, right? But that is not financial advice. Just saying, today that property is more than doubled. So my burn rate, if I had liquidated that property, I would have gotten 600K for it.
Yep.
I would have had to pay the bank 480, agents fees, so on and so forth. Let's say circa, I would have walked away capital gains tax with 80 or 100K.
Yep.
If my living expenses for a year is $100,000, that money would have lasted me 1 year.
Yep.
Now that property, the loan is still 450, is worth $2 million, right? Now think about that. 2 million minus 450. Let's just say capital gains tax, whatever it might be. Say $1 million in my hand. Now that one property has made my burn rate 10 years.
Sure has.
So when people sit and whinge and bitch about fuel prices and avocado prices, mate, are you going to stop feeding your family apples and fresh fruit because it's too expensive? How many times have you seen a little old man driving a beat-up old car, living in a $100 million mansion? Because the mansion kept up with inflation, the man did not.
Yes.
Right? And that's why, my friend, I love money. Not from that not from a status perspective, not from Rolexes and Bentley. Don't get me wrong, I love all that stuff. That's not the point. The point is that making the right financial decisions, understanding where to park your money, will change your life, will give you freedom like nothing else. Will give you freedom where you can get up tomorrow morning. And you know what? Sometimes you want to walk away from your boss and be like, yo, I need 6 months to myself to really sit down and think to myself of what I want to do. And I'm not going to have to compromise on how my kids or my wife lives or where I live and how I eat, whether I can drink a beer or not. Of course, I don't care if it's $20 a pint. We'll be okay. I would care if I didn't have my money parked somewhere else. Right? And that, my friend, is what I want to talk about today. I think diversification is rubbish. So today's topic, ladies and gentlemen, is about me officially telling you, I think, and you can sit there in the comments and tell me how crazy that sounds, I think diversification is rubbish. Conditions apply. So hear me out, and we're going to have a little bit of a brainstorm around this, right? When Steve Jobs committed to the technology business, he did not go and hedge his bet saying, you know what, I'm going to set up Apple, but then I'm going to park capital to buy an apartment in New York, and I'm going to go buy a Vanguard fund. No. All in on Apple. That was his legend. That's all he wanted to do. Build a technology business. Elon Musk went 100% on technology and alternate electricity. Elon did not say there and go, you know what, I've got $10 million. I'm going to put 2 million in Tesla. I'm going to put 1 million in shares. I'm going to put, no. He just went all in. And once you go all in onto something and that starts to generate you money, yes, then you diversify. So for example, I went all in on real estate. Now, my life that I live off the money I earn. The passive income I receive can go into cryptocurrency and shares, and every month that rent comes in, 25, 30, 40, 50K, whatever it might be, and that money goes straight into shares or other assets. That is when I can't service. That is when my borrowing capacity is short. So what I feel, when you have limited amount of capital that you can allocate in the marketplace, you're just starting off, you got to commit to one thing. And that one thing has to be your circle of competence.
Look, I agree with what you're saying there, and I think I'm glad you brought that in at the later part of that is you need to focus and not diversify at the start of your journey, of an investment journey. And it doesn't matter which way you go, real estate, stocks, shares, bonds, whatever you want to put it in. Right? Stick to one thing though for a
100%.
Good solid 5 to 10 years. I 100% agree with that. And then diversify as life opens up or it starts to flower, let's call it, and you're exposed to other type of investment classes as well. Because look, the reality is anyone smart, I should say, has never jumped into an asset class and just hedged their bets and say, yeah, I'm just going to park $100,000 and it's my only $100,000 of liquidity into cryptocurrency. Those that have, some have been paid off really well. Those that have as well have also lost it. All right. So I guess it going back to what I'm saying.
If that's your sword and you're willing to die by it, so be it.
Well, exactly. We're not going to take that away from you. And I think that's a great way to see things. And some people are super successful by going balls to the wall straight away.
Straight up.
But I agree with you in saying that focus on something for at least a 10-year period, or just give yourself a deadline at least, and then say,
mate, what would you say
after that?
What would you say to your kid if he said, Dad, I'm going to go to uni, I'm going to do law, marketing, medicine, engineering, IT, renewable energy, metallurgy, civil engineering, and nursing all together? What do you think he's going to, do you really think he'll end up doing anything in life, or he'll just rack up a hex debt, right? Could be the smartest kid, right?
Yep.
We are told to focus. Now, once you do one thing, you might work in that industry and then decide maybe this is not for me and you want to make a switch. But you got to commit to something,
Yes.
right? You just got to commit to something and make and that comes down to your comfort level and so on and so forth. So let me give you an example here. Some people go, but diversification, being safe. If you've got $80,000 or $100,000 to your name, you don't have capital. Let's get real. Like if you've got 100K to start with, that's what you're starting with. Bro, you're not a big hedge fund. You don't have $10 billion. You're going to diversify over different asset classes. You've got 100K. That's just enough deposit to probably buy a $650,000 property, or you buy shares. Pick. I like property because leverage, I can multiply my 100K like it was 600K. There's annual income that I generate from it. Australia is very pro property and I love it. And I understand it. And that's what we do.
Yep.
If you were some crazy day trader who thinks this is what you're going to do, then don't be a coward and go fight. Or, I'm just going to day trade with $100. Are you joking? You were telling me about a Forex guy. Every trade is $5 million.
Yeah.
And he swears by it. And I'm okay with that. He might say to me, going, Kesh, your real estate game is super slow for me. And I respect that. Yes. I don't understand his game. And I'm not going to go $5 million all in on Forex. Yep. That is not my circle of competence. Nor am I going to waste time saying, I will do this online course for $3,000 that'll make me $1 million. Are you joking? I'd rather pay a guy $3K and be like, mate, tell me enough and go and trade for me, and I'm happy to lose 100K if I have to. So I really think diversification is dead, and people often go through this mental masturbation, if you want to call it, of satisfying themselves watching this YouTube video and money gurus and creating this buckets, and man, they get excited about budgets. I get it. That's your initial part, right? The other big problem is with money and loving money, you got to take emotions out of it, right? You actually got to fall in love with money.
Yep.
And everyone thinks it's a dirty thing. And that's why I want to say it again and again. So it doesn't seem like a dirty thing. It becomes a dinner conversation for you. If you love your money will love you back. You'll be respectful of that. You will value it. People misjudge the love for money as in being conservative. If you love it, it'll come back. Go all in.
Exactly.
It's like, bro, money is like, it literally grows on trees. It's like farming. If you know how the economy works, and you and I have spoken about this, the monopoly board. If you keep going around monopoly, get this. Let me give you an analogy. Think of this. Imagine you and I playing Monopoly. Yeah? Imagine we both get, I don't know, whatever, $1,000 to start with. I go to the bank and say, listen, mate, even before we've started, I'll give you $100 if you let me roll 3 times before. Mark, I'll give you another $100 if you will give me a 10% interest, another $1,000. So wherever I land, I can buy a house straight away. Right? Leverage. I'm exchanging capital before the game has even begun to turn the tables to my favor. You as an amateur might go, what an idiot. He's just given back the bank $200 for another $1,000, which he's promised to pay $100 back every round he goes. But guess what? I've already built on Mayfair and the other ones. Now the game starts. Yeah, I might be sitting there for a bit, and you might have 1,000 cash. And I might be sitting there for a bit with only 300, but I got assets on that table, man. And one time, it's all it's going to take is for you to one time land, and you're bankrupt.
Yeah, that's right.
That is life.
It is the game of life, isn't it? Monopoly.
It is. It is the game of life. Imagine people go, I will take public transport and waste 2 hours and I'll not pay $40 for parking. What is your hourly rate? I would pay $80 for parking and drive my own car and put fuel in, because in that 1 hour, I would have probably made XYZ dollars that is worth it, so that I'm not arriving to a meeting where I'm sweaty, tired, late, and irritated. Because that is what my hourly rate is. When doctors are on call, they drive. They're not standing there waiting for a train.
Yeah.
Because they're getting paid for it. Mate, so I reckon this episode, guys, I want you guys to get this from this episode. Spreading yourself thin with limited capital is the easiest way to destroy your future.
So not get ahead. Correct.
Not get ahead.
Yep.
The second biggest thing is emotions, right? So let me give you another analogy. You know how in Monopoly we get money to start with? Let's say in real life, everyone doesn't get an equal playing ground. So Ryan, you, I, we all start at different, right, in life, and then you end up wherever you end up. But at every level, there was a decision you could have made. There was a decision at your own level you could have made.
Yep.
Right? So when I started off, when I was investing, could I have rented a $500 a week apartment? Yeah. I rented a $180 studio above the garage, but I still had the A4. Right? Because that was important to me at that point, right? I wanted to be comfortable because I spent a lot of time in the car looking at deals.
Yep.
But my living, I used to be there only at night.
Yeah.
And it was just me. I'm like, bro, literally pay $180 a week. Keep my outgoings as low as possible.
Yep.
Right? So let's think of it this way. You're starting off. You've got 200K cash saved up over I don't know how many years, right? Or inheritance or whatever it might be. And then let's say based on you and your wife's income, your borrowing capacity, say $1.5 million. What you got to understand is that is what the bank is giving you to start your game. Now you like an idiot, if you went and said, I'm going to go buy a house and land package that I'm going to move into, and I need 40 millimeter bench. Oh, but it's still a property. It's an asset. It's going up. You're justifying it. At least pay rent. You have just allocated capital to a thing that is a shelter. The equity in that asset will not do anything for you if your servicing doesn't increase. Right? And the only way you can access that equity is by selling it. So now you've lost your shelter. So your first move on the board of the game of Monopoly was to spend all your money for the fanciest moving bit. You didn't buy a house. You didn't build a property. You didn't think of the fact that, hey, if this is what I'm starting with and it's taking me so long to save up this deposit, why do not I allocate this capital towards something that'll earn me some sort of income? Where someone else is, I put this $200,000, I've taken the bank's, whatever, $600,000, and someone else is paying the mortgage. And if there's any shortfall, I fix it up with my tax. Why don't I buy an income generating asset first? Because if I commit to an asset from the get-go that is depending on we going to work, what happens if I lose my job?
Yep.
If I lost my job today, my properties would be okay.
And I like how you bring up, Kesh, talking about people with, let's assume you had 100K capital today. Let's go back to 1980 or 1990 when people did have 100K capital, and that was considered a lot of cash in the bank at the time, right? What did they do? If we look back at Australian investment 1990 compared to Australian investment in 2022, we could probably say that, and I don't have the numbers, so we should find the numbers and try and put a post up about it, but I would dare say a good 60-70% would have just bought their own home to live in, right? And I wanted to make mention of this on today's episode is a home is not an asset, a property is, right? And some people may or may not get that. I'm assuming most that would be watching this would get that, and I hope they understand that. But the reality is those that invested that were here in Australia in 1990, that may have been earning anywhere between $60,000 to $100,000 a year. And again, as even a combined income, if there was a combined income at the time within the household, earning 100 to 120 was probably a decent income, right? And again, I've got to go back through the numbers, so I don't want to comment too much. But looking back on that, you did not see people taking 100K and putting it into 20 here, 20 here, 20 here. Yeah, all right, deposits were a lot lower and properties were a lot cheaper. So assuming it was a $200,000 property in a middle aspirational ring suburb here in Sydney, you probably would have picked up a decent little property that now would be valued at $2.5-3 million for about $200,000 back in 1990.
100%. Right? I get it. If
back then, I'm assuming, and again, if we just look back at the type of investing trends, let's say, people would have just said, right, I've got a 10% deposit. There was no LMI back then, things like that. I'll put my 20K in there, but I'm going to stay liquid for a bit as well. Right, we didn't have much higher interest rates back then. Also, some high inflation rates too. Right, so it was a pretty bad time if you look at it compared to where we are in today's market. And then we also look at the fact that people saw that liquidity, because they were getting better returns on their cash in the bank anyway. It was better to just say, let's just relax and sit tight. We don't plan on getting up tomorrow and going to Mars or something. So we need to, load up our assets, right?
Yeah.
It was a long game. That was the definition of the long game.
The reason I'm laughing at that is because some people, just their assumption for buffers is just ridiculous.
It's stupid. We see it all the time here, right? With clients, and they want to park it into this, park it into this, park it into this. And exactly like you're saying, I mean, at the end of the day, yeah, it's better to have $10,000 in one thing than $0. I get that. I completely get that. But the old mentality was, if I pay the home off, which we do say these days isn't the right idea anymore, but yes, get rid of the mortgage. But then they started becoming a bit sharper, those that got ahead really well, and they recycled that equity, right? They didn't just sit on it and say, I've got an unencumbered home. They would have said, all right, let's take out another 100,000.
You know how I made the joke of interest only forever?
Yep.
I'll give you. There'll be some guy who'll say, you can't do that. They won't let. You can.
You can.
Right? You just refinance and you can.
Yeah.
So get this. If I was paying, say, $5,000 a month mortgage, say out of that, 3,000 was interest and $2,000 was principal. I'm just giving you an example, and I decide not to do that, right? I look at the mortgage as a 3 or 4% outgoing, but my house is performing at 6 or 7%. So it's all right. That 3K or 2K in a Vanguard fund is performing at 6.5%, 7% per annum. So why am I using that money to pay down a 3% debt when I can use that money to get a 6 or 7% return?
Correct.
Right? People don't, that level of diversification is different, right? Where I get the shits is when you have very limited funds. Say you have 100K. 100K is just about enough money to buy a $500,000 property.
Yep.
And respectfully in the market today, anything sub $500,000, it is a purchase like, buying something is better than nothing.
Well, haven't we recently mentioned that the average borrowing capacity in Australia, if we calculated roughly, is about $520,000, right? So we are going to be saying in, let's say, 5 years from now, wow, do you remember when properties in XYZ were, let's use Adelaide as an example. Right, Adelaide will hit.
Mate, there's some pockets that have touched a milli. There's some, I was looking at, bro, it's Adelaide and Sydney have had 28% neck and neck same growth in the last year, right? Smart money migrates, but I'm just saying, like, say for example, I've got 100K and I go, no, but I want to put 50 in property. You won't be able to. You're not going to be able to.
Start off with a quality asset, mate, to begin with, whatever it may be. Mate,
100%. The second thing to going all in, and I think diversification is bullshit, is fear. Is fear, and it is an excuse that people use to not action anything. Oh, I'm thinking I'll put X amount of dollars in these shares or X, and then when I turn around and ask them and I go, so how long have you had this money for sitting in your account? They go, 6 months. I go, how long did it take you to save it? Oh, maybe 4 years. And I go, so in the last 6 months, if you have all these ideas that you're discussing with me, why haven't you actioned it? If you've got it all figured out, why haven't you actioned? Why have what?
I'm looking.
What are you looking
researching?
At? What?
6 months of research to park 100,000, I think, is a little extensive. If it was 600 million, I get it. There's a lot of due diligence involved, but it's...
The worst is from this sort of person. Sometimes you hear I've heard of day trading. I've heard of this. I'm like, mate, you are shitting yourself to buy a mum and dad property that someone's going to rent and you're going to hear day trade. Yeah. I'm like, based on what? Yeah. Because they watched 8 YouTube videos, But I'll tell you what, I have a solution to fear.
Yep.
I really, really do. I believe that in 2022, there is a lot of help. There is a lot. I'm not talking about shady Amazon drop shipping courses. No, I'm not calling them shady. I don't know whether they're good or bad. Yeah. But listen, I'm going to show you how to be a millionaire. Why would someone sell you a $5,000 course to teach you how to be a millionaire? If that person really knew how to make you a millionaire, would have charged you $5,000 an hour for every meeting.
Yep. I agree.
Because that's what their time's worth. If I could guarantee you that I could teach you how to be a millionaire in 6 easy steps, I would charge you $5,000 an hour. If I'm going to teach you how to be a millionaire in 6 easy steps, and I'm going to charge you, say, 100K, that's 10%. Would you not pay $100,000 if I could teach you to make $1 million? The only reason he's selling a $5,000 course is because he's looking for a sucker.
And look, you know what? This is life. You know, everyone feels as though, you know, I need to see value first, then I'll pay. Well, you know, and
why don't you eat dinner first and then decide?
Well, exactly. The other side of the fence. I mean, you want to eat fast food because you're on the go. It's the convenience. So you pay for the speed, convenience, in and out. I've got to go. Right? Might not be the most healthy alternative, but at the end of the day, the human body needs to eat. Right? You go to the bar. You don't try the beer and then decide to pay. Right? But we know what the outcome is going to be with the beer after we finish it. Most of the time, it should be a good feeling.
I think where people are not committing is that they want to diversify. They have these great ideas, and I think Google's doing a massive disservice, leading people into massive analysis paralysis. And I think, at least for real estate, I can tell you, there are so many more people working in an industry where they're working on the seller's behalf and not on the buyer's behalf. And now it's becoming popular, and I can see that because I think there's no good or bad property. It is just people need to know what's right for them.
Yes.
They need to sit down with someone. I wish someone did that for me. This is what we do for people, is actually run those numbers. So when we come back from the subscription break, I'm going to tell you the professionals that you actually need and want to go to and speak to. And please pay for their time, respect their time, and get the right advice. Ladies and gentlemen, Friday Night Live, subscription break. Subscribe now. Let me take a big sip. Let me take a big sip.
For
like a
audience,
big gulp.
Here we go. And if Alison's watching today, she would most certainly put you on your bottom.
Oh, mate. That girl, I wouldn't take her up on a chugging competition. Can't
Shout
do
out
it.
to
I
the
give
finance
up.
team.
That's it. Girl power to her, mate. Like she's a chugger. Producer Ryan was embarrassed. He still gets nightmares about it. on our little subscription break, we were talking rubbish, so that conversation is from there. If you want to know about Thirsty Thursdays, let us know in the comments. But coming back to what I was saying, learning and finding the right people, right? So the first thing I think where people really need to understand, and why I really think our topic is very important, is often people don't really realize how much funds need to go where and what the risk profile is. And they think speaking to a financial planner, again, I'm not throwing them under the bus, is going to give them some magical plan where he's going, what is your risk profile? So medium, long? Mate, you're not ordering a Subway. Yeah. You want a 6-inch or a foot long. Understand what's possible for you and have a conversation, right? So the first person you need to speak to is a person who's actively doing what you want to do.
Agreed.
Right? So if you want to get into property development, speak to someone who is property developing. If they don't have the time, speak to someone like us who can give you insights on what to do, where to connect, so on and so forth, right? If you are looking to buy an investment property, what are your investment goals? How quickly, how much are you willing to spend based on your borrowing capacity? You don't make a decision. Sometimes I sit with people and go, I don't want to spend more than $700,000. I'm like, mate, you can't. Your borrowing capacity is 600. That's not part of it. So you think you are not, no, you can't.
Other way around.
It's the other way around, right? The banks tell us, right? So sit down with someone who understands what you require and gives you a little bit of a reality check. You know, I feel a lot of times people, especially through this boom, when I can only talk about real estate, were wasting their time going from one open house to another, hoping that a $1.6 million property would get passed in some magical way. They'll get it for 1.2, right? And in their head, their budget's 900. Why are you looking at $1.2 million homes then? You're in a bull market and you think you're magically going to get it, right? So that's a little bit of a waste of time. You're wasting time, fuel, your energy, whatever it is, right? I think first and foremost for me, I sit down and I work out, what do I have right now? What do I need in my portfolio? is my servicing really, really strong, but I struggle to save cash. And the reason I might be struggling to save cash is maybe because I've just started a new job that pays me a lot. So to speeden up my process, and I know that on a year-on-year basis, my income is going to go up, I'll have a very capital growth heavy portfolio, right?
Yep.
With such low interest rates, I'm not a big fan of negative gearing unless I'm buying some magical property.
Yep.
Not a big fan of negative gearing if I don't have to. The second thing I look at is what sort of property do I really need? And who can provide this property to me, right? There's no bias between new versus old versus this versus that. Everything has their pros and cons, right? Sit down with someone and get clarity. And then decide how you want to pursue that journey. Do you want to do a DIY project? Are you going to go out there from one open house to another, one land developer to another, one home place to another? Let me give you a small example. The other day I was sitting with someone, he goes, I want to build a duplex. I want to name the location, whatever it is. I want to build a duplex. And I go, great. So there are two ways to do it. Either we can find you an existing house and land package, so you know in a house and land package, what has actually happened is the builder has put down an option on the land, has spent $3,000, $4,000 on soil tests, contour tests, architect's plan, looked at the DCPs, what is allowed, has done all the work up front for you, and he adds a little bit of a margin because they've outlaid capital and say, yep, this is a cookie ready to eat. But if you're someone who likes to go to Woolies and buy your own, flour and chocolate chip and that, which is I'm okay with that, right? Then you need to go and speak to someone who can get you access to that land. Or if you're going to source that land, then be prepared to go to an architect, pay $3,500. He will do a design for you, right?
Yep.
Go to the get all of that done. Get your borrowing capacity done. Make sure your mortgage broker can get you a construction facility for the construction of it. Be prepared for lower valuations. Be prepared for construction delays. Do your due diligence with what are the actual deliverables. Make sense? So a lot of people waste their time thinking that they want all this information off Google or by an hour's conversation, right? Sometimes I have people sending me realestate.com.au links saying, what do you think of this? It's a link. What do you want me to say? What do I think of one? It's like you walking down. If I ask you, what do you think of that chair? Like, what's the context here? I have no idea. What do you want me to say about this property? Is it a good or bad property? I don't know. Might be great for me, maybe shit for you.
Yeah.
There's no good or bad property. It is very subjective. What are your goals? If you're looking at a site, which is an 1,800 meter square block with an old house, for me, I go, this is a headache, mate. I don't have the capital, the time to buy this property, go get an architect, demolish it, build 8 town. I don't have the time or the energy. And if I do, then be prepared. If you're going to make that money, I'm going to sell a DA-approved site. Mate, make your life easier. Get a buyer's agent, get a builder, pay them their fees, let them go out and do their FISO for you, stack it up, and you go forward and sell it. What are you wasting your time for? I just don't understand. Like Sydney alone has 700 plus suburbs, right? So people think they want to go speak to a property guru, which I hate. There's no property guru, and go, mate, just tell me this magical thing where I'll be a millionaire guaranteed in 10 years. It's not going to happen. It's a lie, right? But if you sat down, either you go to a place which will, like for us at JR, we've curated the entire journey. This is the person you need at this stage, and we will connect you with them. There's a support system, and there's someone constantly coaching and guiding them through the process.
Yep.
Hey, mate, based on your scenario, based on this, the 2 ways you can go, A or B. Which way would you go? These are the pros and cons. Yep, I'd like to go the way B way. So, right, these are the trade-offs. This is the timeline to expect. These are the type of properties we're going to get in this sector. Let's go out there and start doing work for you. Right? Very simple. If they require something more curated where we need a buyer's agent or we need a development manager, we need to do a feasibility, we need to do construction or renovate, whatever it is, we'll connect the dots. Because if you do not focus on what actually makes you money, you're never going to be able to do this side project.
No, ever.
So I sometimes tell people, mate, if you work in IT or you're a doctor, mate, concentrate on your business. Do you not think spending an extra Saturday on your business or on your personal skill set will get you a better return? And I'll just pay I can sit and do my own returns. Why do I pay an accountant?
That's right.
I can do my own bookkeeping. Why do I pay my accountant?
Yeah.
Why do people pay $300 or whatever, $450 sometimes to renew their ABN, whatever, on an annual? You can go online and do it.
Yep.
Because, mate, my time is so much more valuable.
Correct.
I've instructed my accountant, like he does it on autopilot, the invoice comes, it's paid.
The thing is, though, Kesh, people, and look, I can understand from both sides of the fence, and this is not subjecting or putting it on anyone in that regard, all right? But those that have this, what we would call somewhat the easier route, where they are paid week in, week out, whether they're 25, 35, 45, 55, they don't understand the concept of I'm running out of time. They don't value their time because their time is already
one thing you can never buy back.
Correct.
You can never buy it back.
And it's not about saying, oh, my time is worth, I'm a contractor, I'm worth $200 an hour, I'm worth $5,000 a day, right? That's not what we're talking about here. What we're talking about is saying that every day that we go by, we'll never get another Friday today.
Mm-hmm.
This Friday is going to be gone and it will never come back. The next Friday, the same thing. And we are losing time. And yes, people look at it and go, oh, but I can save a few $1,000s by doing this myself. You can, yes, you absolutely can. But the problem is that you delay it now. So now the time that's lost is not necessarily the time of your life. It's the opportunity cost.
It is.
So it's the other side of the fence now.
So you tell me one thing. I don't know if you've seen that on Amazon Prime. You know, the whole eastern suburbs.
Yep, Lux listings.
Lux listings. I think that's what it's called. Even in America, they've got a buyer's representative and a seller's rep.
Yep.
People are buying $18, $20 million houses in New York.
Yep.
They can. If I'm buying an $18 million house, I can fly private here, and you know they're the upper echelon of society.
The reality is, without going into too much detail with personal transactions and whatnot, but people that are buying in these affluent suburbs, of pristine cities around the world, they're not taking out mortgages. Right? They're not. They're paying their stamp duties, which are in the millions of dollars in cash. They're buying the homes in cash.
But why are people? That's what I'm trying to understand. If ultra wealthy people, success formula is to hire the most. Right? So if you're an employee and you work as a daily contractor or whatever it is, and if a company is paying you $1,000, they're valuing you as a professional.
Yes.
Because by paying you $180,000 or $260,000 a year, whatever it works out to be $1,000 a day, right? They know you're solving $1 million problem for them.
100%.
So when you're trying to get financially free and you want to do all of this sort of stuff and you want $6,000 or $10,000 back in tax, you want to understand negative gearing. You want to know what the hottest spot in the market is. Don't buying a $20 report or a Google YouTube video like this is not going to solve it for you.
It's not.
Think of the project cost. If you are here telling me that you want to build a multi-million-dollar portfolio, you want $200,000 in passive income, right? So let's say it takes us 15 years to do that. $200,000 in passive income. Say 15 years. Say you're 50 years old by the time it happens, right? Not that you'll be 15, but you get what I mean. Let's say you live up to 86.
Yep.
Multiply by 86. So you're talking about a $17.2 million project that you want someone to deliver for you. Along the way to earn $200,000 worth of passive income from investing, you need conservatively, about $5 to $6 million in net investments, debt-free. So we're talking about buying $6 million worth of real estate. That'll give you $17.2 million worth of revenue through your lifetime from 50 to 86, right? And you wanted all this from a YouTube. Are you joking? You're talking about a so even if you, for a fraction, say you want a $5 million project, even if you paid 2%, that's $110,000 that you should have allocated. If I'm thinking of a $5 million business today, If I tell you, mate, I'm going to set up the best restaurant in Australia and it's going to be on the water and I'm going to charge people $800 for these dishes and I'm going to have the most rarest Japanese whiskeys, and then I should be prepared to pay, I don't know, a couple of mil a year in rent.
Yep.
I got to be prepared to not have waiting staff at $20 an hour, but $30 an hour from the best hospitality schools. I need to have, I don't know, the best crystal. You know, I have no idea about the restaurant business, so I need to have a Michelin star chef. I need to spend, I don't know, producer Ryan will say, Kesh, maybe like 3 million marketing, right? So if I'm trying to do I have an X project in mind, what am I putting aside for that project? Because when a developer is going out there, mate, just to get a valuation, a commercial valuation, sometimes 15, 20, 30, 50K. For a valuation of a site that they may or may not buy, because the project cost is $100 million. So they know that I got to allocate 2 or 3% willing, but this helps me narrow down to the project.
Yep.
And if you don't understand this, dude, you're going to be a struggler all your life. All your life. The other day, mate, I'll give you a quick example before we wrap up. Tools of the trade, right? So I was sitting with someone and they had the most rubbish phone and rubbish laptop. So they were typing out an email on Outlook, and every time they would type a word, it was taking time to load up. And I noticed it a few times, and he was getting frustrated. And I was like, and his phone while talking couldn't hear, right? And this person essentially uses a laptop and phone for their work. They work in the insurance industry, and they got to send out quotes all day. Yeah. And they talk. These are their tools. If they were a tradie, that's their drill. And I go, mate, like, he goes, you know, like a new laptop will cost me $5,000. Phones are $2,000. Like it's $7,000 outlay, mate. I said, what do you earn every year? And he goes, probably about, on a good year, 180. Bad year, 120, because it's base and comms and insurance or whatever. So I said, all right, so let's take $150,000. Let's take $7,000, right? $7,000, and let's divide it by $150,000, right? That's 4.6% of your annual income generated from these tools. That's for year one. These tools will last you at least 3 years.
And the rest.
Right? So if I go $7,000 for a new laptop and phone, divided by 3, that's 2,333, divided by $150,000. So I spent 1.5% of my income to make sure. Do you think he would have maybe been able to send an extra email? Maybe he would have had better customer service because people could hear him. And you know, someone who's listening to this going, why didn't he do it? Saying, mate, then why aren't you doing it? When you're out there looking at properties, you're looking at shares, you're doing this, do you really think a Google search, a $30 report is going to give you the answer? It is ridiculous.
Absolutely ridiculous.
You got to be kidding yourself. So on that note, mate, I reckon, this is a wrap. I reckon diversification is rubbish. Go get help. There is help out there. And yes, some people will stitch you up and some people will genuinely give you help. That's on you. And it happens. Sometimes you will pick a wrong partner. Yep. But that comes down to your due diligence. For me, it's very simple on how I select people. Do I vibe with them? What they say, does it make sense? And I have no reason to distrust because we haven't even started business.
Yep. And
I'd rather pay them up front, get the job done, outline my expectations, whether they'll deliver or not, and we go from there. Simple as that.
Straightforward.
Straightforward. I don't like to complicate life, mate. We love money. Cha-ching, just in the bank. But I'm talking about passive. Bro, that feels so good. You know what? That just seeing that amount come in, and you're just sitting there, and I was worrying about something about work. For a second, I was just like, wow, I ordered myself a $30 lunch. I really did. I'm like, shit, yeah. It's passive income. This was a decision I took 10 years ago. Yeah. How good does that feel?
And in those 10 years, you haven't been watching your market accurately. You haven't been going on your CBA account every day, looking at the value of it.
The only thing I do every year, burn rate. Yep. Burn rate. If you are comfortable and you think, oh, life will go on, especially people who are like, you know, age group of 30 to 45 are the worst because you earn and you spend and you earn and you spend and you think, oh yeah, this wheel will go on forever. you got to do this. Because your mortgage, your car repayments, your children, your life, your travel, everything is dependent on you exchanging time for money.
Yep.
And the day you can't have that time, your time is not valued. Like I was speaking to someone in commercial cleaning the other day and I showed him a video. I said, do you know the robots in China that go and clean up bathrooms and they climb upstairs? Each robot costs probably 80 grand, right? This is a depreciating asset. I can pay 80,000. These are the new photocopier business.
Yeah.
And tomorrow I can just go get $1 billion cleaning contract from a CBA level bank or whoever their facilities manager is for the properties they're renting.
Yep.
And you're done. No payroll, no super, no sick leave, nothing.
And the amount of tax you're getting back as well is going to be a lot different.
100%. Robots just clean. Right? So, again, yes, is it a pipe dream? Is it this? Is it that? I don't know. But there's always going to be something that'll disrupt you. Right now, I know IT contractors for that have been being paid a lot over the last 2 years because the borders were shut, the companies were desperate. But when borders open up, how many more IT professionals will come through? And what will happen to those wages? How many jobs will be... Most jobs are not going to be here in the next 10, 15 years. Right? Where are the Holden factories? Where the Ford factories go?
Yep.
As real estate gets more and more expensive, further up we go from the cities, maybe it'll be vertical farms, and being a farmer, you'd have to be a bioengineer.
This is a possibility. Yeah?
It is, because what people don't realize is we in the economy with the internet and capital, like I told you, are moving way faster just because you're sitting on your ass and you're trying to go DIY. Dude, I'm one of those people. I don't buy IKEA furniture. Not that I've got a problem with it, but I do. I'd pay someone on, I don't know, Airtasker to come and put it together. I'm not going to spend my Sunday afternoon putting a cupboard. Are you joking? Give him 200. I'd rather go out with my wife and have, like, that's our time together.
Yep.
I will never have that Sunday back.
Absolutely agree.
So value your time. If you don't value your time and you don't actually go out there, think of what project it is. You're coming and saying, I want to have XYZ in investments. I want to save 10 years off my mortgage. I want to do this and I want to do that and I want to. So the person that is assisting you do this, what quality of service are you going to receive? And you got to go to the right people. Do you even know who to go to? Not all. And guys, I'll tell you this from experience. Not all accountants are made the same.
Yep.
They're not. Not all builders are made the same. Not all advisors are made the same. And I'll tell you what, in this industry, in any industry, if you want to really get to the top 1%, do you know the difference between a Bob the Builder and a name builder and the name developer? Is that they're on their fingertips, on speed dial, they have the best bricklayer, the best concreter who comes to them.
Yep.
Do you know why he comes to them? Because they get paid on time. That is the difference. You're not paying. Sometimes people think, oh, a brick is a brick. Then if a brick is a brick, why does a brick in Blacktown cost 80 cents and that same brick put in a house in Vaucluse costs $30? A brick is a brick.
That's right.
Right? A house is a house. Why do people pay architects? And those houses, when you walk through them, you go, oh my God. That feeling, my friend, is the expert. On that note, guys, this has been another episode of Friday Night Live. We're missing Sean. Hey, should we do thingy?
A round robin.
Yeah, let's do it. You do it.
I introduced one last week. We call it, I've got to look back, but we're going to call it the elevator pitch.
The elevator pitch.
So just like an elevator pitch, we have to end the session with a tip from you, for example.
Yes.
And that is going to be, right now you have $100,000 in your bank account. What are you going to do with it?
I have $100,000 in my bank account. What am I going to do with it?
Now, mind you, you're in a lift right now with a CEO of a massive company, and he's asking you, what do you do, blah, 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 in that instance, in that setting, and he's just asked you, I've given you $100,000, what are you doing with it?
Wow. What am I doing with it?
So
Property.
He's going up to level 35.
I say, if you're giving me 100,000,
We're at level 10 already, so
I
we're
am
in the
me.
lift. You got to answer quick.
I am me with this skill
right
set.
now, 100,000.
Property. Let's do it. If I wasn't me, I'd probably give it back to him and say, mate, teach me your ways. Introduce me to your network.
I like that.
If I wasn't who I am right now, and if I was me at 19, and he said, here's 100,000, what are you going to do? Say, mate, I'll give you 101, but let me shadow you for 6 months. Introduce me to your network.
You actually took my answer as well. I was going to say that learning a skill, people
100%.
don't see that as the investment. No. But teach a man how to fish, he'll live forever. Give a man a fish, I'm sure
I've said this to so many people. I go, you went to university, spent 3, 4, 5, 6 years of your life, and no university will guarantee you a job. And you went with the hope that if I finish this, worst case scenario, I'll get 80K, 90K package. That is a very sad way to live. It is a very sad way to live. Dude, with Ryan, like, we bounce so many ideas off each other. And the reason we are able to move with so much speed is he's not trying to do what I do. I'm not trying to do what he does. He understands what I want.
Yep.
And he, in his own marketing expertise, his own media expertise, is able to deliver. And there's some stuff that he doesn't understand that we outsource. And we pay a professional for it. Because in my head, what is my project cost? And what amount of capital am I willing to allocate to that?
Simple.
Time and capital. That's it. You want things done on your terms, you pay for it. Right? Or
Agreed.
if you're going to pay less, then it's going to happen on my terms. Terms of money, my friend. You can't have both.
And that's how the banks play with us, and people don't see that.
That's true. That is true. Ladies and gentlemen, that is Friday Night Live. Thank you very much. See you next time.